Hey everyone, welcome to another video on my channel. It's been quite some time since I posted the last video because I was out of station. So since I'm back in Bangalore now, so I'm going to make a video today on time in the market versus timing the market. We might have all heard this quote that time in the market is more important than timing the market. But today what we are going to do is take the data, try to analyze the data in depth about Nifty and see how significant this small factor of staying invested in the market is going to make difference on our portfolio. So all this comes to picture when we often tend to feel that okay, the markets have run up too much, maybe we should start booking profits. So it is not wrong to book profit. The only issue is if you end up booking the profit, the question would be when will you enter next. So in case if you miss that timing, it is going to screw up your entire returns. So often whenever we see the market come down, right? So maybe post elections when BJP didn't get the majority they were looking for, so the markets fell almost around 6-7%. And even post budget when the capital gains was increased, so the markets came down by almost around 5%, right? So all these factors, when we see a sudden fall, it will actually make us feel afraid, right? So once we feel afraid, we feel okay, we have already realized so much profit, what is the point of not booking it? So we tend to book the profit as well, right? Not just this, there will be other things surrounding us like news, right? So usually in the news, they tend to portray something much bigger than what has happened. So in case if it is a good news, they tend to hype it up. And in case if it is a bad news, they tend to hype that up as well. So they present scenarios which can be the worst case scenarios possible, but they present it as though it is going to happen. Media is one of the key responsible players in spreading greed and fear among the people. So with all this, we usually end up selling our stocks or booking profits in our stock. So now let's quickly move on to the video and we will take a look at the data, right? So and see how significant this might have costed you. And we are going to see how significant is the impact of missing out on really good days in the market, right? So along with that, we are also going to see how we can end up optimizing our returns, so without having to book our profit in case if the market crashes, or let's say you have a lump sum. Next, we are also going to see without booking our existing investments, how we can plan out things in a better way such that we can optimize our returns. So all this will be covered in this video. Before we move on, I would like to talk about the sponsor for this video. The sponsor for this video is Ditto Insurance. So Ditto Insurance, as you know, is backed by Zerodha and they are spam free. So they are not going to call you up and pressurize you to buy insurance. Rather, you can arrange a one-on-one call with them. So they will try to understand your needs, your necessities, and they will suggest you the right insurance, right? So you can have a free consultation call with any person from Ditto and later choose to buy an insurance if it is meeting all your needs. So their only intention is to guide you right. So we have also made a vlog where Sumuk also took an insurance policy with Ditto, so you can also check that out. So unless I use a product and I really like the product, I do not recommend it to any one of you. So this is something which I have tried and tested, and trust me, they are actually spam free. You can also check out our services at Quick Alpha by going to quickalpha.in or click on the link in the description below. So right over here, I have taken the Nifty data for 10 years starting from 2014. So we have done a thorough analysis already, so that's the reason I'm not going to go through the whole way of how you can analyze the data. So based on our analysis, so the total trading days what we had in the last 10 years was close to around 2615 days. So that was the total number of trading days, and out of which you can see, so Nifty has gone up on 1400 days and come down on close to around 1200 days. So if you take a look at it, the probability of Nifty going up or coming down is almost around 50-50. There is no much big difference, right? So 1400 days up and 1200 days down. That means the entire return, so whatever returns we have made, has come from a very small portion of days which has actually added up to the growth in Nifty. So you can see out of the last 10 years, Nifty has given us a total return of 300%, 292% to be precise. So Nifty was close to around 6,000, currently it is at 24,000. So the return comes out to be around 300%. So in this 300% return, you can see that nearly 63% of the overall Nifty return has just come from the top 10 days. That means if you weren't invested in these top 10 days, right? So very likely you might have missed out on 60% of the overall returns out of this 293. And not just that, so if you had missed out on top 25 days, so you would have missed out on close to around half of Nifty's entire return. So assuming that you have invested for a decade, but you miss out on the top 25 days, only 25 days, which is 1%. So we are just talking about one single percent. So if you end up missing this 25 days, so very likely you will end up getting half of what Nifty has delivered. So if you end up missing the top 50 days, right? So top 50 days is just top 2% of the return days. You will mostly end up missing the entire Nifty gain. So very likely this wouldn't have happened because it also is the same case on the downside, right? So if you miss the worst days, so very likely you're going to save a lot of money. But why I'm specifically stressing on this is the fear would be the highest when the market actually falls. Let's say, assume during the month of COVID, right? So March the market started to fall and April the market actually made the bottom. Assuming that due to all the widespread of fear, you actually missed out. So you booked your profit maybe sometime during the end of March and you missed out on buying stocks in April, or you didn't hold any stock in April. So most of the good days, right? So most of the best performing days actually came in the month of April and May. So that was the time when there was the highest amount of fear. So very likely you might have missed out these top 10 days if you hadn't invested in April and May. So now moving forward to maybe the budget time or the election time, right? So on the budget day or let's say on the election day, right? So Nifty came down almost by 7%, and fearing that if there can be a market crash, so many of the people might have actually booked their profit. So they might be already sitting on a very good profit and they decided to book all their gains. But here the next 2 or 3 days what we saw, right? So that actually contributed to maybe the best performing days in the last 3 or 4 years. So if you actually look at it, the 3 days post the worst performing days, right, were the 3 best days in the last 3 to 4 years. So which means whenever there is highest fear, right, so where we feel like exiting most of our positions, so that is when following that comes the best days usually, right? So very likely it might have happened that we might have missed out on these top 10 days because they occur when there is the maximum amount of fear. So whenever the fall is intense, so usually the bounce back is also going to be equally intense. So that's the reason we cannot really call the top or we cannot really call the bottom when we are invested in the market, and that is not the right way to do it also, right? So in case if you're doing your SIPs or in case if you have already invested in the market, rather than trying to see when you can actually book profit, one thing what you should really focus on doing is try to see how you can optimize your return. So unless this money is not really required, so basically in my opinion you should only consider 2 important reasons, so these two to be the important criterias why you might have to book a profit when the market is at an all-time high. So the first reason might be assuming that you have any short-term or long-term commitment. Let's say, so you might be planning to buy a house, you might be planning to buy a car, or you might be planning out for your children's education, right? So when the market is actually going at an all-time high, it is good to sell and keep the money safe. Assuming that you have this commitment in the next 2 or 3 years, it is actually a wise thing to book at the top. So this might be one of the reasons why you might actually consider selling your investments when the market is at a rise. So it is okay even if you miss out on top performing days, because the priority is not to keep your investments growing, but the priority is to safeguard your money for the upcoming commitment, right? So this must be your most important reason why you would want to sell anything when it is at its peak. The second reason why you might want to sell anything at its peak is mostly because, let's say, you have a better investment opportunity elsewhere. So let's say you might want to invest privately in some business, or you feel that okay, currently something else has become cheap and it is offering much more value, right? So in case if you identify any other asset or any other instrument offering a better value at the price, and you feel this can potentially give you much more returns going forward, this can be your second reason why you might want to sell anything at a peak, time the market, and later end up shifting your investment. But if these two are not your primary criteria, so then I would say maybe just for the sake, because the market has gone up, you want to end up booking, might not be the best way to go ahead. So next comes the question of how you can optimize your returns if this is the case, right? So to optimize the return, there is a very small trick which we can end up using. That is to go back and see how Nifty has actually performed. So irrespective of how the market has moved, generally Nifty offers great value whenever there is a 15 to 20% correction. So we don't know when this correction is going to come, right? So irrespective of when the correction is going to come, that is the perfect way or perfect time to invest a lump sum. So what we can simply do is continue with our SIPs without breaking them, irrespective of where the market is, but we can also save up additional amount. We need not bring them in to the markets when the market is making an all-time high, so we can put it in much safer instruments because we are already having our SIPs running. But we can use a 15 to 20% correction in Nifty whenever it occurs as a brilliant opportunity to end up investing this lump sum. So till now we understood that it is not really good to time the market, but sometimes when the market is actually coming down, so we cannot obviously call the bottom. We don't know whether the crash is going to stop at 10% or the crash is going to stop at 15 or 20%. But what we can certainly do is try to optimize our returns. For example, here I have done a simple analysis, that is to see in the last decade, in the last 10 years, how many times Nifty has corrected more than 10%. So when you actually look at the dates, so you get to see that totally there are 6 instances where Nifty has actually come down by more than 10% in the last 10 years. Which means once in every 2 years, there is a chance that Nifty might end up correcting by 10%. So as I already told you, we cannot call the bottom, but what we can certainly do is whenever there is a 10% correction, right? So we can actually invest a lump sum, right? So we do not have to actually wait for the market to make the bottom, or we do not have to call the bottom of the market, but we can simply use a 10% dip in Nifty to invest some lump sum amount in the market. What difference is it going to make? Let us find out. So if you actually take a look at it, so normal CAGR of Nifty or normal compounded growth of Nifty is around 13%. But instead of this, if you actually try to invest a lump sum at every dip, this would have actually yielded you XIRR or internal rate of return of 17.2%. So you can see this is much higher than your regular SIPs in Nifty because you're trying to invest whenever the market makes a low. So we have also seen that, so maybe every once in 2 to 3 years, there might be an instance where the market actually comes down by 10%. So using this data, what we have seen here, so today in this particular video, we understood that there is no point in trying to time the market. So call this the top or call this the bottom, right? So there is absolutely no point in doing that. And the second thing what we understood is, so instead of trying to time the market, we can actually try to use every dip as an opportunity based on the data. So it's really difficult when you actually have to do it because you get tangled by emotions. So as and when the market is falling, you will really be scared. But keeping that aside, if you just try to focus on your investment by simply trying to put the money whenever the market dips, you will be in a much better position. With this, we also come to the end of this video, and I hope you found some value out of this video. If so, then make sure you hit the like button, share this video, and subscribe to my channel. Thank you so much for joining, guys, and see you soon in the next video.